Welcome to our deep dive on cash versus mortgage, the dangerous myth of investment leverage. First, we will frame the core dilemma: whether to use savings for a debt-free purchase or take on a high-interest mortgage to invest the difference. Next, we will unpack the 15% delusion behind aggressive return assumptions, then quantify the risk-free return you effectively lock in when you avoid a high-rate mortgage. After that, we will explore the psychological edge of peace over profit, and conclude with a practical playbook and a quick quiz to cement the ideas. Let's get started. Here is today's roadmap. First, the core dilemma. Second, the 15% delusion. Third, the risk-free return from paying cash when rates are elevated. Fourth, the peace over profit argument. Fifth, a practical step-by-step playbook. Sixth, expert consensus guidance. Finally, a short quiz to reinforce learning. Let's move to the dilemma. First, the core dilemma. With elevated mortgage rates, should you pay cash to eliminate debt and guarantee an interest savings return? Or take a high-interest mortgage and invest your remaining capital in hopes of earning more than the mortgage cost? While spreadsheets can make leverage look attractive, reality introduces taxes, volatility, and sequence of returns risk. Let's examine why aggressive return assumptions are so dangerous. Before we proceed, an important disclaimer. This content is educational and not personalized financial advice. Your specific situation, including your income stability, emergency fund, tax bracket, time horizon, and psychological tolerance for volatility, must drive your decision. Consult a qualified financial professional before implementing any strategy. Now, let's unpack the 15% delusion. Now, the 15% delusion. Many leverage proponents assume double-digit compound returns, sometimes 12 to 15% annually. This is irresponsible. Long-term diversified equity returns typically cluster around 6 to 10% before taxes. After accounting for taxes, fees, and real-world volatility, reliably outperforming a 6 to 7% mortgage is uncommon. Worse, a market drawdown can coincide with your fixed high-rate mortgage payments, compounding stress and risk. In short, leveraging based on optimistic assumptions can be financially dangerous. Next, let's quantify the guaranteed return embedded in paying cash. To structure the decision, consider this flowchart. If your mortgage rate is 5.5% or higher, paying cash is usually prudent if feasible. If your rate is below that threshold, evaluate your risk tolerance and the strength of your plan, including emergency funds, diversification, and rebalancing discipline. If your tolerance and plan are strong, you might consider modest leverage combined with dollar-cost averaging. If not, paying cash remains the safer choice. In either case, redirect freed cash flow into systematic investments. This pie chart illustrates the non-trivial value of paying cash. The largest slice is freed cash flow, representing the monthly budget relief when you have no mortgage payment. The next slice is risk reduction, reflecting the elimination of interest rate, refinancing, and margin call-like risks from borrowing to invest. The final slice is psychological well-being, the intangible but significant piece that comes from owning your shelter outright. Together, these components can outweigh the theoretical edge of modest leverage, especially in high-rate environments. Now let's quantify the risk-free return concept. Here's the key insight. If your mortgage rate is 6.6%, paying cash produces a guaranteed return equal to that rate by avoiding interest. More precisely, it is a risk-free, tax-free 6.6% because you are not paying the lender. This creates a hurdle rate. Any leveraged investment must reliably exceed 6.6% after taxes, fees, and volatility to justify borrowing. In practice, clearing that hurdle consistently is difficult. Additionally, avoiding interest payments boosts flexibility and improves your ability to withstand market turbulence. Next, let's compare cash and mortgage approaches directly. Let's compare. With a cash purchase, you guarantee a return equal to the avoided mortgage rate, gain free cash flow, reduce risk, simplify taxes, and enjoy psychological stability. With a mortgage plus investing strategy, you might outperform if your after-tax returns reliably exceed the mortgage rate. However, this requires strong risk tolerance and disciplined execution, and it introduces sequence of returns risk where a downturn can collide with fixed payments. The leveraged approach tends to work best when mortgage rates begin with a 4 or lower. Now let's lay out a concrete playbook. Here is a practical 4-step playbook. First, when mortgage rates are 5 to 6% or higher, secure the housing asset by paying cash if feasible. Second, redirect the amount you would have paid toward the mortgage into monthly dollar cost averaging across a diversified portfolio. Third, maintain a 6 to 12-month emergency fund and rebalance annually to keep risk aligned with your plan. Fourth, optimize taxes by prioritizing tax-advantaged accounts where available and using tax-efficient funds in taxable accounts. Next, we will visualize how this unfolds over time. This timeline shows a 5-year journey after paying cash. In year 1, you purchase the home outright and begin dollar cost averaging with the amount that would have been your mortgage payment. In year 2, you maintain your emergency fund and adjust contributions as income changes. In year 3, you rebalance and consider tax loss harvesting if markets decline. In year 4, a market dip tests discipline, but you stay the course and keep buying. In year 5, compounding becomes evident as your portfolio value overtakes your cumulative contributions. Now, let's reinforce key parameters with a simple table. This table summarizes assumptions versus practical realities. First, optimistic return assumptions often fall in the 12 to 15% range, but historical diversified returns are closer to 6 to 10% before taxes and lower after taxes. Second, when mortgage rates are 6 to 7%, the hurdle is high and difficult to clear consistently on an after-tax basis. Third, in a downturn, leverage magnifies pain because investments fall while payments remain. A cash buyer is not burdened by required payments. Finally, cash flow is constrained by mortgage obligations under leverage, whereas paying cash frees cash for consistent dollar cost averaging. Next, let's capture the expert consensus. The expert consensus is straightforward. Unless your mortgage rate starts with a 4 or lower, the prudent move for most people is to secure the housing asset first. Then, convert the dollars you would have spent on interest into strategic monthly investments using dollar cost averaging. This approach aligns risk with reality, not with overly optimistic spreadsheets. Before we wrap up, let's test your understanding with a quick quiz. Quiz time. If your mortgage rate is 6.6% and you pay cash instead of borrowing, what effective, risk-free return do you lock in? Options are A, 3.3%, B, 6.6%, C, 10%, and D, 15%. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B, 6.6%. By eliminating a 6.6% mortgage, you secure a guaranteed, tax-free return equal to that rate because you avoid paying it to the lender. This becomes your hurdle rate for any leveraged investment strategy. Second quiz. When might modest leverage be reasonable for a primary residence purchase? Options are A, when rates are 6 to 7% because markets usually return 15%. B, only when you can time the market perfectly. C, when the mortgage rate starts with a 4 or lower and you also have strong risk tolerance, diversification, and a dollar cost averaging plan. Or D, never. Leverage is always bad. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. Modest leverage can be reasonable when the mortgage rate starts with a 4 or lower and you pair it with strong risk tolerance, adequate savings, diversification, and a consistent dollar cost averaging plan. High-rate environments make this far less attractive. Here is a simple checklist to integrate the lesson. First, if your quoted mortgage rate is 5 to 6% or higher, favor paying cash. Second, confirm you have a 6 to 12-month emergency fund. Third, keep return expectations grounded in 6 to 10% long-run averages rather than 12 to 15%. Fourth, commit to dollar cost averaging the freed cash flow every month regardless of market conditions. Fifth, stay diversified and rebalance annually. Sixth, optimize the use of tax-advantaged accounts before adding to taxable accounts. Now let's close with key points and a final summary. Key takeaways. First, high interest rates make leverage fragile, so avoid unrealistic return assumptions. Second, paying cash when rates are 6 to 7% locks in a guaranteed, tax-free return equal to that rate. Third, peace over profit matters. Cash flow, resilience, and psychological stability are valuable. Fourth, If your mortgage rate starts with a 4 or lower, and you have discipline and a robust plan, modest leverage may be acceptable. Fifth, invest freed cash through dollar cost averaging to benefit from compounding. Finally, let's summarize and wrap up. In summary, secure the home first when rates are high. Treat avoided interest as a guaranteed return. Channel freed cash flow into disciplined monthly investing. Keep expectations realistic and plans simple. Before we end, here's a quick creative ask to support the channel. Thank you for watching. If this video helped you rethink leverage, please like the video, share it with a friend who is house hunting, and subscribe for more clear analysis. In the comments, tell us your current mortgage rate, whether you favor cash or modest leverage, and what gives you the most peace of mind.